Hello traders, Gary Wagner here. It is Monday, March the 16th, 2020, and this is a special report of the gold forecast. Absolute carnage and mayhem hit Wall Street today as all of the U.S. equities as well as safe haven assets closed dramatically lower on the day. In fact, what we witnessed was a spike up in Australia Monday morning in gold, which quickly faded. We also had an emergency announcement by the Federal Reserve yesterday that they would lower interest rates by a full percentage point, taking current interest rates effectively to zero. After that announcement made, the Dow futures sunk even deeper. We can't say that that was the cause of it, but we can say that after the announcement, we saw more selling and carnage. The Dow Jones Industrial Average closed down almost 3,000 points. Traders, I have been involved with the market since 1983 and was part of the 1987 Black Monday sell-off. During that sell-off, it was much quicker, but it retraced to about 50%. You will see as we pull up our technical studies that we're still at around 30% in terms of a retracement of the Dow, so we could see it go lower if Black Monday was an indication of where U.S. equities could go now. Let's take a look at our price board and then our technical studies. Although we have seen the Dow Jones Industrial Average along with the other composite indexes selling off harshly over the last couple of weeks, today was a game changer. The Dow Jones Industrial Average closed near 3,000 points lower, a total of almost 13%, closing at 20,188.52. That all in light of a dollar. And that dollar was much lower, also actually losing about 0.8% at 98.11. Now, the other prices that I'm going to show you are reflecting the afternoon session, meaning the morning in Australia. You're seeing it up $28, but that's after a tremendous double-digit decline this morning. In fact, it took pricing down as low as approximately 14.46 before recovering. So the change that you're seeing now is just a bounce to the upside, but it doesn't reflect the true nature of what we saw happen today. Silver, unbelievable, below $13 at $12.99. Platinum also $670.70, up 13, but again, take a look at where it fell. It fell to $561 before recouping to $670. That's the kind of day we've experienced. Palladium is still continuing to drop. It dropped this morning, but it is now trading at $14.60. So we're actually seeing palladium for the first time in quite some time below the price of gold. It is truly an unbelievable day. Other indexes, the NASDAQ Composite down over 12%, and lastly, the Standard & Poor's down over 12% also. Let's take a look at our technical studies. To give you an idea of how far the Dow has traveled to the downside, I've pulled up a weekly chart and put a Fibonacci retracement starting in 2009, meaning when the crisis of 2008 began to diminish and we saw stock prices rise from about 65.25 up until this most recent top at just shy of 30,000. When we do that, we can see that we are roughly at the 42% retracement. And what is interesting is if we compare the retracements of both the financial crisis as well as the Black Monday crisis that occurred in 1987, on both occasions, we saw retracements that went as deep as 50%. Now, if we see the same thing happen again, history repeat itself, then of course we've got quite a bit of downside to go. And it doesn't appear as though it is firming up in any way. And I would expect this market to trade lower. And the next number I would look at would really be about 18,000 on the Dow. That would occur at a 50% retracement. So I want to compare the last two big corrections to the one we're currently facing. What we are looking at is the Dow Jones Industrial Average during Black Monday, which of course occurred during October 19th of 1987. We can see that it hit a top right here in the Dow at 2752, and from there fell over 50%. From there, we had action by the Federal Reserve that propped that market back up. In other words, Black Monday recovered extremely quickly. Now let's take a look at the crisis that occurred in 2008 and 2009. Now, traders, we are looking at the financial crisis that occurred in 2008 to 2009. You can see that the market topped off here in 2009. From about, say, 2002, the market ran upward. However, I am starting the retracement from back in 1995, 3,600 on the Dow, up to 14,000. The retracement itself goes beyond the 61.8% level. That would be here. It goes almost to the 78% retracement level. And this low here is where we began our next retracement that we looked at the beginning of the show, which is this retracement going from 65.25 up to the highs at almost 30,000 at 29,492. And as you can see, we are quickly approaching the 42% retracement. All the other retracements that we looked at, both in 2008 as well as on Black Monday, went past the 50% retracement mark. If that's an indication of what we might see, we could see further downside. We are looking at gold through a daily chart. I have a fib retracement that runs from 685 up to the record top at just over $1,900 per ounce. When we do that, we see that the low today matched the 38% retracement point. Also, we have a tremendous high as well as a low. We will break that down with an intraday chart in a second. But the key is the low that it made actually went below 1496, and my sense is that 1440 is a point that it must hold. The 38% retracement is a pretty critical level. That comes in at 1450. So if we get more downside, we could see the market move as low as 1450. If by chance we find support and get a nice kick up, this would be a fairly logical place to look for it. But we have to have technical confirmation that that V has formed, meaning we have downside action followed by a move up. In other words, we're not going to catch a falling knife. That is not what we did yesterday, and the reason being is that it gapped so much higher on the open. To really illustrate that, we need to look at an intraday chart. To completely understand how this market traded, say, over the last 24 hours or from Friday, we've got a 15-minute candlestick chart. We have also drawn vertical lines that represent the start and the end of each day. So, for example, what we're looking here, of course, is the 13th. And when we see where the 13th closes, it is right here, which was about 1517. This represents the open. It says the 15th, but it is Monday morning in Australia, so it is the 16th. That's what we're looking at right here. And here's what we saw in the open. As the market opened, we had a tremendous gap higher from that price. You can see that here, taking it up 63 to 68 in that area. It was the fact that it gapped higher, and at the same time, they were looking at Dow futures opening down 2,000 points that made us believe that there was finally the decoupling between the selling pressure of gold and the selling pressure of U.S. equities. In this case, we were entirely wrong, because you can see fairly quickly the market began to sell off. It leveled off for a little while, and then it really plunged going into New York. This would represent the 16th, or when New York started trading right here, and that's when it traded to a low of about 1450, an extreme low. Now, we've had somewhat of a recovery because right now we're trading at 1508, but I can tell you this. When we look at other occasions in which we saw U.S. equities come under major pressure, 2009, 1987, we have never seen it act in quite the same way. The reason we are seeing such a different reaction on this sell-off in U.S. equities as in the crisis of 87, and it only looks small because of the scaling, as well as the crisis that occurred in 2008 and 2009, they were both financially based. Now, the crash of 87 was really because of heightened hostilities in the Persian Gulf. There were fear of higher interest rates. We had a 5-year bull market without a significant correction. And most importantly, that's the point in which computerized trading really began to come to the forefront, that fast algorithm type trading. Those are financial issues that were solved by financial means, meaning the Federal Reserve. This is truly different, because the root cause of this crash is biological in nature rather than financial. And that might be one explanation why, when the Fed announced they had cut rates by 1%, the market dropped even lower. The Federal Reserve cannot get us out of a recession that is a global recession that is caused by a pandemic until the pandemic no longer affects the world's population. And for that reason, these are unusual times, and it is something that we have never seen occur before. This has been Gary Wagner. We have had a difficult day both in equities as well as the safe havens. I wish all of us health, most importantly, and safety over the upcoming months. Have a great day. We will talk to you tomorrow.